The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program set up in 2003 and is currently overseen by the Monetary Authority of Singapore, MAS, and Ministry of Manpower, MOM. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. Understanding exchange-traded funds, ETFs. This is the second video of a two-part series on exchange-traded funds, or ETFs for short. In this video, we will look at the different structures of ETFs, the risks, and how they can form part of an investment portfolio. Understand the structure of ETFs. In the first video, we mentioned that ETFs can be either cash-based or synthetic. For cash-based ETFs, the ETF provider will replicate the performance of the index either by holding all the stocks in the index, in which case it is known as full replication, or only a sample, in which case it is known as representative sampling replication. On the other hand, synthetic ETFs don't directly own the assets in the indices they are tracking. Instead, they use derivative products such as swaps to replicate index returns. Direct replication or cash-based ETFs. In the full replication cash-based method, the ETF holds all assets in the underlying index in the exact proportions as the underlying index. While for the representative sampling cash-based method, the ETF holds only some assets in the underlying index, usually the larger ones, so as to reduce the number of securities held. However, the aim is still to track the index as closely as possible. Synthetic ETFs. Earlier, we mentioned that synthetic ETFs do not hold the underlying assets in the index and instead rely on derivative instruments like swaps to achieve the desired performance. This type of structure is usually used for difficult-to-access markets or those which are less liquid and where costs and tracking error could be higher. Synthetic ETFs are complex products that carry greater risk. They may not be suitable for most retail investors. For instance, there is a counterparty in a synthetic ETF in addition to the ETF provider, which means investors are exposed to counterparty risk. Why invest in ETFs? In video 1, we talked about how ETFs may appeal to passive investors who do not want to actively select stocks and to try and time the market. In addition, ETFs offer other advantages such as lower transaction costs compared to unit trusts, allowing investors to diversify into different markets and asset classes, exposure to the performance of an index for a small capital outlay, transparency with real-time information since ETFs are traded on an exchange. Before you invest in ETFs, we will first need to talk about a few things. Suitability. Are ETFs suitable for everyone? Considerations. What to consider before investing. Selection. What to consider when selecting ETFs. And investment. What to watch out for when investing in ETFs. Suitability. So, are ETFs suitable for everyone? Even though investing in ETFs offer many benefits, they come with risk. Here are some pointers to consider before investing in ETFs. Can you afford to lose all or a substantial amount of your capital? Do you understand how returns are determined and the factors that can affect your returns? If you are considering a synthetic ETF, Are you fully aware of and do you understand the risks associated with such instruments? Are you able to put money away for a long period of time to ride out short-term fluctuations? Are you familiar with the ETF manager and its track record? Considerations. Here are some considerations before investing in ETFs. Ask yourself what your investment objectives are and whether investing in ETFs will enable you to achieve those objectives. Take into account your risk profile. Bear in mind your investment horizon, which is the number of years you have ahead to achieve your investment objectives. Focus on the strategy you are going to pursue. Are you going to buy and hold ETFs, actively trade them, or use ETFs as just the core of your portfolio? Selection. Some considerations when selecting ETFs. The underlying asset class or index. The size of the ETF. Trading volume, which will tell you how liquid it is. Its structure, whether it is cash-based or synthetic. Its tracking error. The current and expected market conditions. Investment. Some of the risks to bear in mind when investing in ETFs. Overall market risk can affect all markets, including prices of ETFs, such as a pandemic, wars, or even policy changes like interest rates. Tracking error, which is when the ETF manager is unable to replicate the exact performance of the index being tracked. Counterparty risk. This applies especially for synthetic ETFs and refers to the risk of default by the swap counterparty. Foreign exchange risk. If the ETF is denominated in a foreign currency and the exchange rate moves against you. Liquidity risk. If the ETF is not actively traded. The market price of the ETF may not necessarily be equal to the net asset value per unit of the ETF. Here are some possible investment strategies using ETFs. ETFs can be bought and held for long-term growth and price appreciation. Form part of the investor's core investment holdings, while other actively managed investments or individual stocks form the satellites. Be actively traded like any other asset. Be used to hedge and lower the overall volatility or risk of a portfolio. Here are the key takeaways. ETFs can be either cash-based or synthetic. Synthetic ETFs are complex products that come with greater risk and may not be suitable for most retail investors. ETFs offer many benefits, but all come with risk. When selecting ETFs, make sure they fit with your investment objectives.